Good evening. Welcome to Press Pass. Apologies for the slight delay, but we have a full panel ready to discuss this heavy issue, and this is what's coming up.
What we are borrowing today is already factored in our budget policy statement.
That debt burden is increasing rapidly, and therefore that's not sustainable to maintain these high deficits.
This story on the latest Eurobond and debt levels grabbed headlines end of last week. We look at the various narratives and perspectives and why it should matter to you. It's quite a heavy discussion, but my guests will make it easy for you. They'll break it down and help us understand this whole Eurobond issue in terms of why it was such a big deal and still remains to be a big deal and has received the focus it has across the media houses and various platforms that we have. On my direct left, I have Stephanie Onchwati. She is the fixed income analyst at Cytonn Investments, and that's quite the title there for her. Yes, next to her is someone who's been a colleague here at Daily Nation but is now at the Standard as an investigative reporter. That is Paul Wafula, and has been very keen on matters finances and financial reportage over the years. Next to him is our boss here in terms of business. He is the editor for business at the Nation Media Group, Ochieng. Rapuro, thank you, sir, for making time. And next to him is Kwame Owino, the CEO of the Institute of Economic Affairs, and has been a financial analyst and independent economist, and very keen on the very latest that has been breaking over last week. And just to show you a sample of the numbers that we will be referring to, you will be seeing them as they run, and of course have been used as we were telling the story last week. And this right here, of course, from our business desk, thanks to Alex Mwangi, who's helped me produce this particular episode. And this, the source being the Treasury's 2018 medium-term budget policy statement, the fiscal performance implementation for the financial year 2017-2018. And you can see the revenue and expenditures, the actual versus the actual figures, and the target in terms of how we performed. Now, we are receiving less in terms of the breakdown of these numbers than the targeted amount. We are spending less than the targeted amount, and spending less means their tax revenues are reduced because private enterprises do less business with government as a result. And the government, of course, has given its explanation for this, saying the shortfall in ordinary revenue was on account of underperformance in all broad categories of the revenues. On the second slide, just real quick to go through them, but you will be able to see them as we continue on split screen. And that is, of course, projected budget deficit at the end of the financial year. And as you can see there, to be financed by domestic borrowing, that is the Treasury bills or the Treasury bonds, and external borrowing, there you would have what has happened latest, that is the likes of the Eurobond. But this was actually already projected and anticipated way before this particular Eurobond was taken. And at the end of the financial year, we will have borrowed more money externally than domestically, meaning we will be benefiting outsiders more than Kenyans. On the other slide, we have Kenya's total public debt. Now, this should get your attention. As you can see there, from the year 2017, breaking down 2012 and 2017, you can see there from 840 something trillion shillings being the public debt in 2007. That has gone up 5 times, from 844 billion shillings as of December 2007 to 457 trillion shillings by 2017. And then the next one is Kenya's revenue collection. That is again from 2007 to 2017, and you can see the breakdown there of the numbers. And as you can see, the breakdown being that Kenya's revenue in the last 10 years has grown by 3.6 times compared to the total public debt, which has grown by 5.4 times. Debt is growing faster than revenue, and you can see there a breakdown as this has been explained in various stories that have been done, whether it's on the Standard, whether it's on the Nation or the Business Daily. The next slide shows you a breakdown, simplistic perhaps to some's perspective, of what you and I owe, the total public debt, you know, against the population, and that would be 100,000, at least over 100,000 shillings per head. But you can see the breakdown to this, the figures that will be informing our discussion as we continue. Now, as I was talking earlier, there was this big story on Thursday. It was reported that Kenya had secured about 202 billion shillings in a fresh Eurobond issue on the same day that the International Monetary Fund stated that the country's public debt may soon become unsustainable. Here's an excerpt of what the IMF resident representative had to say.
That debt burden is increasing rapidly, and therefore that's not sustainable to maintain these high deficits. So that has a sort of a concern about stability and sustainability of the whole macro situation. What we're concerned about is the flow of new debt. I mean, so the trajectory is going to a place where it will not be sustainable anymore, and where you will get into trouble eventually.
Well, on a number of occasions, just before we start, we put this to the table and to the panel. The National Treasury, with the backing from the Central Bank of Kenya, maintains that the level of public debt in the country is within acceptable limits and therefore no cause for alarm. Here's the Treasury CS on this particular issue.
Our debt levels remain sustainable at around 50% of GDP in net present value terms, based on World Bank sustainability indicators for emerging or frontier economies like Kenya. Debt levels at 74% of GDP are the levels that if you reach there, you might the country can face a debt distress.
Now, as we were questioning this particular Eurobond, many had said, and that's the viewers and those who are consuming our various stories on the various platforms, that we're being very negative and putting the Treasury to task unnecessarily, because this money that they're borrowing is for development. Are we raising alarm for no reason? I'll start with you, Kwame, on this issue.
No, I don't think so. If we take the worst case scenario, about 11 years ago, some people, including some media houses in Greece, started a debate similar to this. And the response was the same. People in government said, look, we know what we are doing, we wouldn't damage the economy. And other people had a discussion. So even if we don't talk about who's right and who's not, the aggressive growth and the fact that, remember, 3 years ago, the IMF and the World Bank conducted a debt sustainability analysis for Kenya, and their view was that Kenya's debt was sustainable. They have intimate knowledge of our financial position. Yes. That position has since changed. There are people who've been consistent all along, knowing that our debt situation could overwhelm us. So even if you don't think we're in danger, the discussion that we are having is important for us to actually discuss what are the trajectories. And the trajectories tell you we may not admit it yet, but we are in trouble, and this is the point at which the restraints that are required to bring us back to an even keel is important. Okay,
and to Rapuro, our business editor here at Nation Media Group, this story on various platforms, you can just look at this one, Business Daily, of the following day, that is the Friday, actually the weekend edition. Kenyans to pay 323 billion shillings in interest on the second Eurobond, against a story there, right on the same page of the IMF warning. Now, should we have really separated, because a version that we carried, that is NTV, we put it on the same package and said, as we celebrate, or as the government celebrates this Eurobond raising money, 202 billion shillings, the IMF is raising the alarm. Are these two separate issues that we should have approached separately?
Not really, because it's the same subject, all right, but when you look at the details of what was happening at that particular time, it was sort of a conflict of trajectory. Here is the IMF, which public officials have over time relied on while referring to whether our debt levels are at the right point or not, warning us on a day that we basically are celebrating. Yes. The coming through of the $2 billion Eurobond. And so, but when you look at the clips you've just showed, what causes a mix-up from this debate is people flying very close to the truth while not really getting into it.
Okay.
The IMF, the clip you showed of the IMF director, he is talking about the trajectory of debt. In other words, he's talking about the velocity of debt, the rate at which we are accumulating debt. The CS Treasury is basically talking about the total level of debt, which he's saying is around 50% net, you know, and he says that is a level that is acceptable and far off removed from the 74% that the World Bank says is dangerous for countries in our stage of development. Mm-hmm. And so it takes quite some courage for public officials to accept that where we are getting concerned about the trajectory we are taking. And we are being told by experts in this matter, including the IMF, the ratings agencies, that the trajectory is not correct and the velocity is too fast for us. Mm-hmm. And the numbers you showed there are quite sure. We have a revenue base that is growing organically, you know, adding less than 10% year on year. But the debt is growing at close to 20% every year. That kind of imbalance is what is causing this concern that we will soon reach a place where we will not be able to sustain our run on the treadmill that we have already stepped up onto.
All right, and Paul, as you've been following this, and on that very day that this big announcement was made, we had someone who was actually meant to be on this panel, but I think out of protocol issues, he was not given the green light to come, and that is Dr. Jeffrey Mwao. He is the Economic Secretary at the Treasury. And we put it to him whether we are ready and this is the best time to be borrowing more money. And they actually said, he said that this was budgeted for and we had prepared for this. And in fact, let's listen in and you can respond to this.
What we are borrowing today is already factored in our budget policy statement that was approved by Parliament last June, and it was based on analysis of debt sustainability. And it showed that even with that borrowing, which amounts to about 250 billion in total, our debt position will still remain sustainable.
Right.
So we are within that limit of our borrowing.
Again, the same narrative and the clarification on their side that they had prepared for this.
Mark, something that you have to actually look at and just realize how this government is really lying to Kenyans is how they come up with alternative facts, how it consistently tries to explain its own position using other facts that are not contextualized. Why I say this is because if you realize that your deficit is growing very fast, right, as we have been doing, then you will want to borrow. So you've planned for 600 billion, you'll want to borrow. But the question is, why are you growing your deficit so fast? So the fact that you have planned to borrow does not negate the fact that you are growing your deficit very fast. So yes, the Parliament may have approved it. You can borrow that. The budget policy statement may have said that. But are we borrowing at the right time? Remember, Mark, those of us who follow the business space in the country, you realize that anything that happens at the National Treasury, we are always informed. I mean, even at the Central Bank, we are informed promptly. But we were so shocked, we didn't even know there was a roadshow. If government will have opening some conference here in Nairobi, we'll be invited to go. And yet this is 200 billion we are going to borrow. No journalist is aware. We are just surprised that we have actually landed 200 billion, done in secrecy.
Well, is that their fault, or we weren't doing our jobs?
No, we were doing our jobs. If you asked today, where is a prospectus, for instance, no one knows where it is. It's in secret. They are borrowing money on our behalf. If we have been following the Eurobond story, for instance, Eurobond 2, every time we have asked Treasury, we have been told it's still too early in the day. I mean, we are still talking to people. We are not ready. When we are ready, we'll tell you. So we've been waiting for them to tell us. Then all of a sudden, here we are told we have secured successfully 200 billion. I mean, we are so happy. We could even have gotten 1.4 trillion, 7 times more. So we should be very thankful. We are grateful. We are happy. Yet they're not telling us one single thing. What are you going to do with this money? If you talk to Mao and asked him, you talk to Rotich, asked him, give us just one infrastructure project that we're investing in. It won't be told. So what is going on?
Well, they say, and I'll bring you in here, Stephanie, as you were following, I'm sure you're following this particular story and the attention that it got. Some saying, why are you not giving the government a chance to invest in our infrastructure? It doesn't take a day for it to start plowing back, or the investment that we put into, for instance, the SGR. So we need to give it time. We borrow to invest and make a better life for ourselves. So in your view, are we raising the flag of necessarily?
Mark, in my view, the government is borrowing to invest in projects that are, at the end of the day, supposed to return enough to pay for the projects. So the question is, are we investing in such projects? Are these projects going to pay back what the government is borrowing at the end of the day? Are we borrowing at a rate that we can actually say that the investment projects that the government is investing in are going to be able to return much more than what we are paying back in terms of debt service? So it's a question we need to look at as a country. It's something we should not ignore, definitely. And a lot more should go into selection of which projects are going to be invested in, and especially in terms of what we borrow, especially if we borrow at commercial rates, which are definitely higher than concessional rates. We need to make sure that these funds are channeled towards projects that can actually pay back the debt that we're taking on.
Are we wrongfully citing the SGR project this soon, as we keep asking questions about where this money is going? As we tell this story and ask these questions, are we wrongfully citing the SGR project?
No, the SGR project is actually one of the projects that the government said had invested the previous Eurobond issue in. So the SGR project is a very big bone of contention. Some might argue it is actually going to be one of the white elephants that might not be able to pay back, because first of all, if you look at the terminals that they're ending at, you'll find that most business people who are transporting goods from the Mombasa port to Nairobi might not be able to use it because it might not be as convenient as it is. And then another issue people are bringing up is that a lot of money got lost in terms of when the project was running. So we don't know where it is, and people are raising the issue whether the SGR is actually going to be able to pay back this debt. And here we are going towards the SGR, the second phase of the SGR, and we're also looking at projects like LAPSET. So we want to see whether these projects are actually of quality and are going to be able to return what we are going to borrow in order to invest in them.
Rapuro, you want to jump in here?
Yes, I just want to respond to the Director of Budget, Dr. Mwao's position that the borrowing that we've just done was budgeted for, and therefore we shouldn't be worried about it. If you look at what we signed up to with IMF when we were negotiating the facility, the stability facility in 2016, one of the things that Treasury committed to, they were actually projecting that the deficit this year, 2018, would be 6.9, and they committed to reducing it to 3.9. Where are we? We are directly going the opposite direction. We have actually ended up at 8.9 currently, you know, and now we are promising that in 2022 we will have come to 3%.
Yeah.
So I mean, when it comes to planning, you could not argue that an entity whose planning produces such outcomes is actually seriously able to face us and say, there's no cause of worry, this is something we knew about.
Right.
Now, to come to your point about the loans and investment, I think I should correct my sister there that the SGR loan is quite separate from the Eurobond borrowing.
Okay.
SGR is actually built with money which is mainly from Chinese, you know, the Chinese Exim Bank lending to Kenya for that purpose. The biggest critical issue here when you talk about investment vis-a-vis the expected return on our investment using debt money is actually to go to Eurobond 1. it's unfortunate that Eurobond, the auditing of it is not complete. The Auditor General's annual report, year after year, says they cannot tell whether the entire amount came back into the country. Mm-hmm. But that be as it may, what we should actually put our foot down to is, and which has been a question that has been asked the Treasury, to show a list of projects in which we invested Eurobond 1. And this is a list that has not been produced this far, and we are going for the next one. As Paul is saying, this has been done. No information has been released to the people of Kenya, who are the owners of this debt, right, as to what we plan to do with this money. This information should come out from the prospectus, which the Treasury has so far not released.
And I'll have to take a break here, but when we come back, just perhaps something that has been brought up by Rapuro, we perhaps discussing Eurobond 2, and we haven't really gotten all the answers to Eurobond 1 and the ramifications it has to our economy, and whereas we're being told, let's move on, this is for development, and whether we should just sit back and wait for it to plow back some results or ask more difficult questions. And one of them is, are we borrowing money to pay the former debt that has been accumulating over time? Some crucial questions and, of course, observations you're making here. We'll sample some of them when we come back. quickly, some of the views that you have raised. Desmond Karani, you say there are countries with, and you can take notes down as I sample some of them. Desmond Karani says there are countries with way higher debt to GDP ratio. You cite Japan at 240%, US at 108%, Jamaica at 107%. Can we let development happen uninterrupted? Or maybe we can sit down with our $10 billion revenue per year and get on with it without anyone complaining. Crucial question that is raised there by Desmond, and we could perhaps become a bit more interrogative on that issue. Joe Ali, you say it's bizarre how the government borrows with a lot of glee for infrastructure but reluctant to invest in industries. Industries is where Kenya's productivity should come from to enable debt repayment, but it must be economic sabotage. So you quip. And yes, let me just scroll down here and get something else that is yes. Babette Abednego, you say, thanks for coming up with this nice discussion. I think Eurobond issue created much attention because the previous debt, nobody explains how it works. And again, this one, Eurobond 2. So we'd want to start with the questions from the previous Eurobond and some of the things that we are continuing with without having covered the previous one. What are the red flags that we need to raise as we tell this story now?
Okay, let's start with the fact that as Kenyans, we are the ones who will be paying really. It's not the people from Treasury who are negotiating it as they travel out who will. It's our taxes that will pay for it. That we haven't seen a prospectus that binds us to pay for a loan that will take us 30 years to pay is just unfair. But I also think that it misses the significant constitutional question of transparency that is required under Article 201 of our Constitution. So obviously, there's something about it that is legally worrying. The second point is that if you look at the first Eurobond, one of the justifications that was given for it was to ease government from having to borrow by stretching the tenure and therefore pay, therefore ease its payment terms. If you look at it, at the time the first Eurobond was brought in, we were paying loans every year, rather we were paying redeeming debt every year for less than 300 billion. Right now we are at 600 billion per year. Which means you're paying 1.5 billion per day in terms of loans, notwithstanding the fact that it was used, the first Eurobond was used to justify, it was claimed it will help us to ease those payments and give us some pressure. The third issue is just a question that, look, questions were asked, it was claimed that this was a political process, and one of the things that made the first Eurobond question even difficult to close was this absence of disclosure. While we are aware of that, we've gone ahead with the same level of opaqueness into the second one. But the third one that most concerns me, the final one that most concerns me, is the question that the first Eurobond, we are being told that among the things that government said was infrastructure investments and to manage some liabilities that government has, which means we are using this Eurobond to clear liabilities that the earlier one had. If you look at the earlier one, there was a 10-year and a 30-year bond, I think split half in half. And 5 and 10, the earlier one. Yes, 5 and 10, sorry, 5 and 10 for the first one. So the 5-year one was given at 6.25%. The other one was at 6% and 7%. Right now we are getting a longer term one for 10 and 30, but basically we are paying 7% and 8%.
Yes.
It's telling you that we are actually exchanging cheap debt for expensive debt. And that is usually a red signal because it's showing we are already at the point where we are beginning to have distress. So it's Peter, borrowing from Peter to pay Paul. And also paying at a higher rate than everything else. So that's basically...
Well, let's get a perspective from the Treasury, because I put this question to Bwana, who, again, as I repeat, was invited for this show and was asked to come for this particular discussion. And on that particular point on whether they are borrowing to repay, here's what he had to say. And this is actually the second last bite that we arranged there, just for my director's benefit.
Let me point out again that, you know, this talk that you are borrowing to repay, it is standard practice in international capital markets to undertake what you call liability management. That is, you are trying to rebalance your liquidity availability with your liabilities. banks do it, international institutions do it, countries do it. It is not just Kenya.
So effectively what you're saying is not, you haven't borrowed to pay what is maturing.
No, it is standard practice.
What you'll be expected to pay next year.
It is standard practice, and I will tell you why. Sometimes when a bond is nearing maturity, it loses liquidity. And most countries, what they do, they actually go and when they go to the market again, they refinance that one to get a longer term bond. And if you look at what we have done, we have gotten a 10-year bond and a 30-year bond.
Yes, on this point, just...
You see, that's not even the question. It's true that you refinance by asking, but we've refinanced for a more expensive loan. That's a significant point. The point is not that you can stretch the terms of a loan in order to ease payment terms. But what it means is that we've actually taken an extra 1.5 percentage points more expensive loan to pay the last one. So it's as if I owed money to a cooperative that I was paying at 10%, and I've borrowed from another cooperative to pay the first, or from a bank to pay the first one at 11.5. That is the point. We've taken a more expensive loan, and therefore our net debt position has actually become worse based on the interest rates. The only thing we've bought is more time. So that's the first. And let me clear, because I need my colleagues to also. Desmond has asked a question, again, which is a red herring. The question is that Japan has 240% GDP to GDP, debt to GDP ratio.
Yes.
And that the US has about 100. And many countries in Europe that we think about have 90 or thereabouts. Do not forget this point. If you forget anything Kwame has said here, don't forget this point. Anybody who makes that argument either doesn't know what they are saying or they are lying. Japan is not Kenya. First, Japan lends in its own currency. The Eurobond will be paid for from dollars. It's not going to be paid for in Kenya shillings. That's the first. The second point, Japan has a 101-year loan, which means the guy who takes the loan today, or rather who gives the government of Japan money today, it's his grandchildren who will be collecting the cash. For us, it's a 30-year horizon. So because it's shorter, it means for us, it's going to be much, much more frequent. Finally, Japan is borrowing at 3%, 3.8. We are borrowing at twice that amount. So there are so many distinctions that that kind of thing, throwing it at us, means you're either illiterate in economics, and I say this with due respect, or you're trying to throw us a red herring. Treasury should not be sending those kinds of arguments to Kenyans. It's unjust.
Something else that's being thrown, and I'll let you respond, and I'll start with her as we play this bite. This is the last bite for my director. The last bite is arranged there. That is still Dr. Mao saying that, in fact, this is actually a good thing that we could attract such interest rates when talking about the good interest rates that we offer on the international market. Yes.
How many countries in Africa can get a 30-year bond? That shows you what investors think about the robustness of the Kenyan economy. First of all, the fair value for a 30-year bond in sub-Saharan Africa is 8.5. We managed to get 8.25. Now, when we started pricing early yesterday morning, we started at 8.6. And because of this appetite of our investors, a broadened base of investors from all over the world, we were able to bring it down from 8.6 to 8.25 for the 30-year. For the 10-year, we brought it from 7.6 to 7.25. So again, it shows you where Kenya is in terms of being able to command good prices for our bonds in the international capital market.
I'll let you respond first, Stephanie.
Okay, so first of all, we have to look at the fact that he said that they were able to negotiate down from 8.6 to 8.3 and from 7.6 to 7.3% for both bonds. So if we look at it from that perspective, first of all, there's the issue of refinancing, whereby the government is taking on more expensive money to pay off less expensive money. So in terms of investment, when you look at that, it doesn't really make sense in terms of refinancing. Of course, we can decide to go the Treasury route and look at it in terms of investors saw Kenya as a faster growing country in terms of sub-Saharan Africa. They saw Kenya as maybe a good investment destination. Our economy is relatively diversified if you look at where agriculture's contribution to GDP came from and where it is currently. But you can also decide to look at it from the point where they're just getting higher returns. So as an investor, you want to invest in a fixed income instrument that's giving you a higher return than it is. So in terms of looking at it like that, then we can say that they're investing in a security that's giving them a higher return. So there are those two arguments. They are to look at it in terms of they see Kenya as a good investment destination, and whether they just want to get the higher returns from the market.
Yeah. I'll have a slightly different view from that, because if you look at what international investors are getting the world over, you find interest rates, people are getting about 1%, 2%. There are even countries with negative interest rates today as we speak. So if you find a country like Kenya that is going to give you 8%, any investor will be running to put money into it. So it's not like Kenya is we should be very grateful that we are getting this upward. It's because they have very few places to put the money, and if Kenya is out there in the market, they look at Africa and say, okay, Kenya is among is top there. But that's not what worries me most. What worries me is what Kwame says. Is a thinking that we have. Anytime we have such an issue, we start comparing ourselves to countries that we are clearly very far away from. Right. If we compare ourselves with the US, why don't we come and compare ourselves with the US like for like in terms of transparency? Does the US borrow and hide the prospectus? Does Japan do the same? Do we have a national treasury in the US that actually does the thing in terms of today you are telling us, look guys, relax, we shall give you the list of projects. Tomorrow you come and say, no, we don't have any list of projects. The other day you come and say, no, we separated the money and say the first Eurobond, I mean this money was put aside so that you can be able to pay the Eurobond. And then next time you come and say, we actually didn't put the money in the same, we didn't separate it, they were in one account, so we cannot actually say which shilling went to whatever infrastructure project. So what he says is that we actually used the first Eurobond to repay the current expenditure. That is something that we should really be worried about. And as Rapuro said, we have come from a very difficult first Eurobond in terms of explanation. You want, when you go back out there, to at least clean your name. You want to go up there and correct your mistakes. You don't double them. You don't go out there with more secrecy. You don't have nothing to explain, because if Mark, you went to a bank today to borrow as a Kenyan and you want to invest somewhere, the first question will be asked, what do you want to do with the money? And you'll say, I will buy a vehicle and I'll be able to do this transport business. You will definitely try to explain your business plan, yes, and the bank will be able to realize that you can actually repay this. So that's what we are asking for. We are asking, when government gets this 200 billion, which we should be very happy that we have gotten that money, we want to see, where is this money going? When we invest in this project, is it likely to repay, as you say? Is it likely to generate the kind of revenue that is expected, that when 30 years come, we are able to repay that loan?
Rapuro, we keep being accused of just being hard on the government for no reason, against development, and it was touted and sold as, you know, a fact that this actually the reason that they wanted to sevenfold offer 7 times fold the offer on the Eurobond, and people say this is a good thing. The world is seeing Kenya as a good investment destination. Then why aren't we selling this story?
Mark, there are a number of things we need to consider while prosecuting that kind of argument. It's true that there was an oversubscription to the level of 1.4 trillion shillings. But you have to ask yourself, this came against the backdrop of our the adjustment of our sovereign rating by Moody's, and again against the backdrop of an IMF warning. So you ask yourself, is there something out there that these investors are seeing in our economy that would shrug off all these concerns that are being raised? And as Paul has put it, there is basically, when you look at what's happening out there, there is money looking for opportunities to invest and to maximize returns. Throughout Europe and America, the returns are basically not more than 2%. So when you basically are looking at returns of upwards of 8%, this is a very irresistible opportunity to put your money in. But you might say, I have seen Dr. Mwao argue there that the fact that we've gotten this money at the price of 8.25%, is a show of confidence in our economy, giving the average of Africa pricing of African bonds at 8.5%. You might want to remember or reflect on the international scene. Over time, there is one big monkey in the market called the moral hazard. The moral hazard is that the international investors will invest in outposts like Kenya, knowing very well that if everything were to go wrong, they will get first priority. The IMF will come in, sit on us, and make sure all the international lenders are cleared off first and leave us to our own devices. Now, the thing here is that when we talk about the borrowing and its success, we cannot talk about this thing in isolation from what is happening out there and the kind of comfort that international lenders have. By the way, they have like a bond, you know, a security that if the sovereign fails to service the debt, defaults, the first priority, you know, the IMF will come in, the first priority will be given to the bondholders. And so there is very little reason why they would not chance giving us expensive money, you know, so long as they are sure that they will get their money back. Two, Dr. Mwau talks about borrowing in the longer term, you know. As Kwame said, this was supposed to ease, you know, our burden of annual payments.
Right.
But when you go then and replace a more expensive debt long term with a less expensive debt, which is short term, 5 years, 10, what is the market telling you? Because in a free market, if you went to borrow from a bank today and you are paying, let's say you take $1 million, Bob, and you want to pay over 5 years, and there's another one where you're paying in 1 year's time, the interest rate chargeable on those over those two periods will differ. And again, finally, when you talk about borrowing, and which informed the story that you showed that we covered on Friday as to what we are going to pay in total over those 30 years, there is one other thing that talks about generational justice, that we are borrowing today to burden the future generations with debt. And that is something that concerns good public policy in many countries around the world. It doesn't appear to be something that we are ready to grapple with at this particular point.
Maura, my director tells me I have to take another quick break, but I'll be back with that question to Kwame Owino on how we have been breaking down the issue of 100,000 per head in terms of the debt that will be on every Kenyan and, of course, our children and grandchildren in the future. And now that it's happened, what else can we do? Are we wasting our time talking here about this Eurobond? It's already happened. Is there any recourse or, you know, ways that we can approach this story to raise the red flag and keep the necessary institutions accountable? Stay with us. Welcome back to Press Pass, and this is the last part of the conversation. And yes, your comments are still coming in and questions being addressed. And for one, Kwame, you wanted to respond to the issue of the government at least selling this as a very positive thing for Kenya getting a very good deal in terms of, in comparison to the rest of the countries in the continent.
Yes, I think there are about 4 or 5 countries on the continent that have taken 30-year debt. And obviously that's South Africa, Egypt, Morocco, Kenya, and Nigeria. And while Dr. Mwau stated that we've got very good terms, I'd just like to remind them that the trends suggest that we didn't get as good terms, because in October last year, Nigeria completed a 30-year bond as well. Their interest rates for the 30-year bond was actually 1% better than ours, which is 1% lower than what we got for the 30-year bond. Right. So 1% over 30 years is a lot of money. So obviously that might require, in my view, what it suggests is that we provided such sweet terms that obviously every bidder wanted to actually get a piece of this. But going now to the intergenerational debt question, that's precisely what's happening. Whoever is in Treasury today, and I don't think Treasury alone bears the responsibility, Parliament bears responsibility as well. Yes. Whoever is approving all these loans might not be here when the time to actually pay and redeem the entire amount is. So we are taking the idea that we can take these loans, spend them whichever way we want, and then kick the debt into the future for our kids and whoever will be alive at that time to do it. And that's why I think it's a very, very cynical move. Okay,
and let's, as you will be sharing your comments, I also want to give an opportunity to what Dr. Mwau said on the issue of the IMF's warning and the deficit that we have collected over time, and at the levels at least that we are right now. And this was in response to the very warning that was given on the same day that we announced raising over 200 billion shillings.
What the IMF is saying is that if we continue that way, but if you look at our budget policy statement again this year, we have shown a lowering of the deficit from 9.1% last year. This year it is going to be about 7.2%. Next year 6%. The year after that 4.3%. In other words, we are reducing the deficit, and that means that our borrowing will be less. The other thing, if you'd allow, we don't just measure debt in gross terms, because since 2012, I saw ISPAC saying that debt has increased. Our GDP has also multiplied. So if you look at that debt as a ratio of GDP, it is very comparable.
As you've listened to what he had to say there in response to the IMF's concerns, is he being entirely honest? Is the government at least being entirely honest in terms of our place where we find ourselves?
I think, Mark, Dr. Mwau has to, he has to say what he has to say, and he's working from a very confined kind of answering basket, that he has this predetermined answers around a specific issue, but he will not go beyond beyond that space, in that he will talk about how good rates we are, how Kenya is a very good investment destination, and so on and so forth. But he will not go to the real questions of why did we need this money today, why are we borrowing it, and where we are going to do the money for. If those questions were answered, we as journalists will be at the forefront to tell Kenyans about that. But if, for instance, these questions are not being answered, and remember, right now as we speak, it's only the Auditor General that is shouting in the dark. He's a lone man standing, and perhaps 3 years from now, people will be asking, who said about this? But all these things are in the audit report. For 4 years now, the Auditor General has been saying the same thing. I cannot be able to say for sure that this money came into the country and was used appropriately. And that is the Auditor General, the person who looks at all the books. Remember, the Controller of Budget was the first person to raise the issues around the Eurobond when we started getting suspicious. But when HIT came, she withdrew what she had said. And then all these statements started coming. Today, Treasury will put up a statement. Tomorrow, a different statement will come up that contradicts what it put. The following day will be a press conference that something else that will come that contradicts totally what they said the previous days. And the lies kept going on until we could not follow it anymore. So when you have that and it's not closed, and then you go back again and we are told you've gotten Eurobond 2, I mean, that is where we're coming from, this level of skepticism. So we have to ask ourselves, what is this that has caused us to want to borrow at this rate? Could we have waited? And if we have gotten this money at this rate, why is it so difficult to say we have borrowed 200 billion and we're going to do X, Y, Z? Why is it shrouded in two statements that say nothing? And finally, Mark, you have to I mean, we have to appreciate that Kenyans need to be told what really is happening. So if Kenyans are not told, and 5 years down the line, and even the words that he says, I'm sure when we look at the budget deficit next year, it will not be where he's saying it is. The year after he's saying 4%, we will be here. It's not too far away. We want to check and counter those words. It is very clear will not be where he's saying he is. But because he wants to get out of the heat at that moment, he will say anything to be able to justify what you're doing today.
Right. Stephanie, in your responses, you've heard what he had to say on the IMF warning and our deficit.
Okay, so where he talks about the deficit and the plan they have, according to the budget policy statement that they released for 2018, to reduce the deficit. So they talk of 7.2% this year, 6% next year, then 4.3 and then 3.7. But if you look at the IMF and why they decided to withdraw the standby facility, the standby credit facility they have with us from March 2018, it's mainly because before, in previous conversation, they had talked about a 3.7% by 2018-19, and here now the government is talking about 6% by 2018-19. So while the government, I agree, have good policies that they intend to implement in place to reach a point where our budget deficit is reducing as they would like it to, it all comes around implementation. So if we look at 3.7% according to what they had agreed upon by IMF, and then 6% according to what they're projecting now, we need to find a place where they actually implement the policies that they want in order to get to that point where deficit is reducing and in turn borrowing is reducing.
Right. There's something there that she's mentioned, another story that perhaps should be pursued moving forward, and that is the freezing of the IMF kitty. What exactly is the story here? And we hear now the Treasury has responded by saying that, and this was with an interview on an international platform, I believe there's a New York Times, Henry Rotich, saying that they will actually review, upon the demand of the IMF, they will review the interest cap rates. What's the story there, Rapuro?
The story is a story of fiscal consolidation. In other words, we are talking, but before I go there, actually, let me respond to the question you asked after you showed the clip of Dr. Mao. I mean, he has very nice words, which we should presume is backed by good intentions of reducing the deficit and therefore reducing our borrowing, because borrowing is a child of the deficit. Now, I think it would be fair to judge Dr. Mao on the record. You know, as I said before, in 2016, when they were negotiating that facility that they withdrew, they made some promises. One of those promises was that the deficit in 2018, this year, they had projected it would come to 6.9, and that the intention was to reduce it to 3.7%. You know, what has happened is we've gone the opposite direction.
Almost double.
Now, if that is the case, then why should we believe him that all these numbers that he's talking about going into 2022 will come to pass? That's one. Two, there were other conditions of which we haven't met a single. There was a demand that we decrease our tax expenditure. That in ordinary language means that we will reduce the tax concessions that we give, you know, and basically this comes from two areas, the corporate taxes and the VAT, where there are so many things that are exempted and also given on concessionary terms. Now, then we promised that we would cut significantly or manage the expenditure that does not involve salaries, you know, of civil servants. And this is the point of wastage, you know, and just diversion of funds. You know, all these other expenditure allowances, per diems, all this, you know, entertainment expenditure and all this. And this takes billions of shillings every year. We promised that we were going to cut that down. As to whether we have done that, your guess will be good as mine. The last thing we promised, you know, was that we were going to use technology to collect taxes better. You know, the answer has come that in all those 4 areas, we never met any of those targets.
Okay.
That's part of the reason. In fact, that's the reason the IMF then withdrew that facility. Now we are negotiating a new facility beginning that is supposed to come in beginning next month, and the IMF is now saying, okay, there were a lot of stuff that came through, including the fact that you are in an election year, there was drought and so on. Now going forward, we have seen a lot of things happening in your space, the fiscal space. Fiscal space is how the policies we use to collect taxes, and then that enables us to finance the annual budgets. Now, if we do not manage that very well, it means the deficit will continue expanding,
right,
and the deficit has to be financed by borrowing, and therefore the cycle will continue. So what actually Treasury mandarins like Dr. Mwaosh will be telling us is what they are going to do to achieve the fiscal consolidation that is required to reduce the pace, the size of the deficit, and therefore the pace of borrowing going forward. That is the answer we need.
Okay.
Yeah.
And perhaps what we'll continue pursuing as we tell this story moving forward. But someone might say, Kwame, and this is in conclusion as we go down the panel, that this already has happened.
Yes.
There's no going back, but some leaders are saying that might take this, legally or to the leadership of in Europe to try and get this to be rescinded, but most probably won't happen. So, in terms of following up this particular story, what are the key areas that we should follow up as we tell this story and as we seek answers from the institutions? Okay,
I think the first is basically Parliament. People put too much pressure on the Treasury because they're the ones who have to announce to us when a bond issue has been successfully concluded. But the truth is, they wouldn't borrow with as much and spend with such profligacy if Parliament took its oversight role more seriously.
Okay.
And those roles are basically constitutional. So the fact that we are getting to burden future generations and even present generations, because already we are paying 3 times more within the 5 years of the Jubilee administration, we went ahead from spending about 240 billion in redeeming debt plus interest to 600 billion. That's a lot of money. So that's the first. The second is just what Rapuro has talked about, which is basically fiscal consolidation. Means we have to discipline our spending and at the same time make sure that we get as much of the taxes that are due to come in. So the concessions and the cheating that's going on and all those have to be blocked. But the third is, look, part of the reason government borrows as it borrows is it's easy to borrow. And the reason it's easy to borrow is both domestically and internationally, but domestically as well, the government is borrowing quite a bit. And that squeezes private sector from receiving loans. And the major claim of that actually again lies at Parliament's door. They passed a bill on interest rates, which curbed interest rates. Most banks are unable to lend at the rates that are available in terms of the ceilings. So what they do is they lend safely to government, and government needs a lot of money and is able to choose, and for that reason gets most of the funds in. So it's in our interest, whether the IMF insists on it or whether our neighbors insist on it or whether banks, whoever it is, rainmakers, whoever it is who insists on it, it's in our own interest to suspend that law. It's not worked in the sense that it was promised to give more loans, or rather to ensure credit goes back to the private sector. It's not. It's killed a lot of micro and small enterprises which MPs were claiming were supposed to be the beneficiary. Let's just cut that law and accept that 1.5 years ago we made the wrong decision. We can reverse it for the good of the country, because we will need those private sector investments to go forward to get the revenues that are needed to close the gap and to pay for these loans that we've already concluded.
All right. Which is what the IMF is actually targeting in demanding that we repeal that law, because in their scheme of things, we need the private sector to grow, to pay the taxes that are needed to reduce the deficit and therefore reduce our pace of accumulating loans. But just to make an important point, the tax spending that the IMF talked about in the earlier negotiation for the facility, the World Bank actually tabulated this and came up with a number, and they said all those tax spending amounts to 350 billion shillings a year. Now look at it this way. We give these concessions and then amounting to 350 billion, and then we go and borrow 200 billion. It doesn't make sense. Right. Why don't we collect the tax and then use it to finance our needs? Finally, on the point that that Kwame just made, with regard to with regard to how the Treasury, I mean, how Parliament needs to manage this process.
Yes.
I mean, it is in our new constitution, no longer very new, the Parliament is the one charged with the responsibility of budgeting. And therefore, the Treasury officials like Dr. Mwao who are speaking to us are just the instruments of the government. It is the MPs who have the responsibility to ensure that we have a solid budget that is sustainable. Yes. And that speaks to our situation, because they have the authority, the legal authority to cap the borrowing by government, and also to formulate a budget. By the way, we have kept on the track of expansionary budget, even when the figures show that every financial year we never spend more than 70% of what is budgeted for.
Right.
But the next year we still put in a bigger budget.
Perhaps some themes that we perhaps need to follow up, and you're the head of business, and this is something you'll be keen on in the weeks to come. First of all, I'll start with you in your concluding remarks, Stephanie. When someone says this is for our development, how much can we actually anticipate if you could perhaps look at the arrangement? This is a Eurobond that was facilitated by Citibank, and we actually invited them. They were not available for this discussion as well. When they facilitate this kind of Eurobond, what actually comes to us in terms of available funds to put into the economy to develop?
Okay, so when we look at the Eurobond, they managed to raise $2 billion US, right? So we have a syndicated loan that's maturing June this year. It's around $750 million US. And then we have the 5-year Eurobond that they took in 2014, also maturing next year, June 2019, also around the same amount. So it will give you 1.5 billion US to go towards liability management, now towards paying those the loans that I've talked about. So it only leaves us with around $500 million US to put into development. So that's what it leaves us with, basically, for development.
Right. And as you conclude as well, it's already happened, but what questions do you want us as journalists to be asking moving forward?
First of all, of course, we have to touch on the interest rate cap. So we want to see, because we've seen already a proposal by the Kenya Parliamentary Budget Office to actually look into repealing this act that capped interest rates. Because if you look at, like my colleagues have said, if you look at the main sectors that are paying revenue, if you look at the banking sector, it's one of the very biggest revenue sources for the government. So once you penalize this sector, then basically you're also penalizing yourself as a government. Another thing is you're crowding out the private sector, who also need to be involved in terms of economic development, because once you involve the private sector, then also you cut down on what you need to spend as a government. So you reduce reliance on government spending to spark economic growth, and you involve the private sector. So those are the areas that I'd like to be touched on.
All right. And how far can you go, as you conclude as well, Paul, as an investigative journalist keen on business matters, to find more answers about Eurobond 1 even before we get into Eurobond 2? What will you be looking for?
Mark, the first things we have to look at and appreciate as Kenyans is that we need accountability. And accountability is simple. You went to do X and you got Y. Why do you get Y instead of X? Or you went to get X and you got X. Simple. That's what you have to come back and tell Kenyans. I'm saying this because as you said, in the entire scheme of things, if you look at what has happened the last 5 years, when President Kibaki left, we were right in control. And anyone from the international markets will not tell us they must give us money, and we say, please give us, because we were able to fund our own budget. We were fine, right? And here we come into this Jubilee government, and we are in a situation whereby today, if we don't get debt, then we are simply going to have a problem in terms of financing our needs. So the situation here is that we are losing power, our ability to be able to stand on our own as a country, as we continue taking up more debt, and we cannot be able to support it with revenue that can be able to actually repay this debt. So tomorrow, if someone decides to recall their debt, we are really in the deep end of things, and that's why IMF is starting to come back and giving us directions. This will not have happened in the last maybe 5 years. IMF will not still come back here. The same IMF that asked us to sack civil servants, that some of its policies have not worked to debt, is now coming back and telling us this. The other thing we have to do is to put this thing in context. You see, Kenyans keep getting billions, and nowadays getting the number billion, it's like a million or 10 shillings. It's no longer any, like we are losing value of money, because we're technically borrowing at least 1 billion every day. Like we've sat here, if you look at that, it translates to about 1 million every second, so to speak. So if you look at this, in a month we are borrowing 30 billion. That means we are supposed to be building a thicker road or so every month. So in the last 5 years, we've been borrowing one standard gauge railway or so, which is 320 billion. Every year we've been borrowing an amount that can build a railway in the last 5 years. So if you were to actually put it into development expenditure, the kind of investment that we expect to get is like 5 standard gauge railways, which you and I, if you walked around the country, we cannot be able to see this. And Mark, remember, this is the same country where we are suffering from drought. Today, Kenya Red Cross is looking for 1 billion Kenya shillings just to be able to alleviate poverty. That's the amount of money we are borrowing as a country every day. And I mean, if Kenya Red Cross gets this, we are lucky. If we had just used the 2014 Eurobond properly, at least take 50 billion and put it into agriculture, or put it into industries, and be able to tell Kenyans 5 years down the line, we borrowed so much money, we've been able to create so much in terms of jobs, we have been able to create or motivate industries to actually produce, and we are sure in the next 5 years we're able to repay. If those answers are not being given, Kenyans deserve to be told the truth.
Indeed, and that is something that we will seek. Of course, it is a harsh audience out there in terms of when we say we are seeking out the truth. In fact, we have been named activists. This panel has been named activists. But these are questions that would be put to whichever government if the same fiscal decisions were being made. It is for the interest of our nation, our economy, and our future. And I'd really like to thank my panelists for making time to come and share their knowledge and, of course, the questions that we should be raising as journalists moving forward. Thank you, Stephanie Onchwati. I believe I baptized you earlier on. She is an fixed income analyst at Cytonn Investments. Thank you for your thoughts, and thank you, Paul Wafula from the Standard Media Group, Standard newspaper, an investigative reporter there. In fact, a nice story you had on today, and we can be looking forward to more on that from the Standard. And the Business Daily, of course, represented by our business editor here at the Nation Media Group, Ochieng Rapuro. You can expect more hard questions being asked about this Eurobond. And next to him is Kwame Owino. Even if he doesn't come on a panel, just follow his timeline. You'll see the harsh questions that he is raising. And even if you call him an activist, he's asking questions that need answers. And many people echo those concerns. Thank you for watching Press Pass. Thank you to Alex Mwangi from the business desk here, who has been very instrumental in helping me with producing this and getting the figures and the facts right. And thank you to the team that is behind the cameras and in the gallery for making this possible. Good night.